All right. Hey, ladies and gentlemen, welcome to another episode of the Beyond Seven Figures podcast. With me today is an individual who has started, scaled, and sold 6 companies. And he did so with all 7 or 8-figure exits. This gentleman's been featured on CNN, The Wall Street Journal, Fast Company, Business North Carolina, USA Today, New York Times. Some of his ventures include a company called KYCK, which was acquired by NBC Sports, Khakis, which was acquired by Remington, InternetSoccer Network. They were acquired by a division of News Corp. He served as a member of the board of directors for LendingTree for over 5 years. He's an angel investor in over 50 companies. He's also the owner of a Spanish soccer team. And now he's focusing really on helping companies exit and so forth. And so we're going to dive into that in more detail. Coming in from Barcelona, welcome to the show, Mac Lackey.
Oh, thanks so much for having me. Excited to be here.
I have to say, when we're talking to CEOs and founders like yourself, if they have one exit, like that's awesome. Good for them. We all know, just being an entrepreneur and a CEO, that there's a certain amount of luck. Now, you have to put yourself in a position to receive luck, right? But when you look at somebody who has one exit, it's like, that was really, really good. But the true skill to how good an entrepreneur, founder, CEO is because can they do it again? And then you did it a second time. And it's like, okay, this guy might have something to him in what he does, but then you did it a third time and a fourth time and a fifth time and 6 times, right?
Yes.
So at this point, the probability of this being a fluke is basically 0. You know something that many people are seeking. What is that magic sauce? How would you define that?
Well, thank you. I do feel like I've certainly been lucky and blessed and all kinds of things in life. But looking back, there have been a few things that I feel like I discovered that are maybe a little different. You know, one of the things after my 6th exit, really for the first time in my working life, I took a break. I kind of looked back over my career because up to that point, it had been one thing after the next, starting the next company, kind of heads down, building my companies and spending time with family. And I happened to be asked to speak at an event to a group of entrepreneurs. And I told the organizer, I said, I'm not a speaker. I don't speak at events. As a matter of fact, I don't even attend events. I'm just kind of heads down guy. But long story short, I agreed. I went to this event. I got up on stage and shared the journey. Here's what I did. Here's what I did well. Here's the mistakes I made. And now in hindsight, it's perfectly clear. One of the things that I said on stage that I didn't think of as particularly unique was I have never sold a company based on a financial multiple. I never sold for an EBITDA multiple. I never sold for a revenue multiple. I always sold my companies based on the strategic value that we created and found a buyer who was willing to pay a premium for it. And so after I sort of walked off stage, a group of entrepreneurs came over to me and said, Mac, I have CPAs, I have attorneys, I have investment bankers. I've never heard anyone share what you just shared on stage. And so, long answer to your short question, I think one of the things I discovered in that moment is that a lot of the value that we create as entrepreneurs gets lost when we start thinking about selling our companies or raising capital because we so quickly are told it's all about the numbers. Tell me your revenue. Tell me your last 12 months EBITDA. Tell me your margin. And we kind of lose the fact that what is creating EBITDA for most entrepreneurs is something special. We have a product, we have a brand, we have some unique process. We've done something that's allowing us to generate revenues and profits. But very quickly that gets sort of pushed aside and everyone says, let's talk about last 12 months revenue. So I think my discovery was that the real secret sauce, at least part of it, is looking at your company, finding that really incredibly strategic thing that you've created that's valuable, and then matching that up out in the world with who needs that or wants it, because someone needs it and wants it. And if you just go out to the market and say, hey, I have a great, 8-figure business and we're growing and we're in this market, you can sell your company, but you're never going to maximize the value that you create when you find that really special buyer that says, I have to have that. And that's a lot of, again, with the benefit of hindsight, I think what we ended up doing reasonably well is matching up something we created with buyers who really needed it or wanted it.
That's great. And the thing is, I think we're very much in alignment because I have this core belief that you get paid in direct proportion to the value that you provide others.
Exactly.
Right. And so if you got an 8-figure business, you provide an 8-figure value, right? You have $1 billion business, you have $1 billion value, right? And so when you have that mindset of, if I get paid in direct proportion to the value that I provide others, then how do I provide more value? So I love that connection. It also, when you put the context on value, it opens up the doors for other possibilities. Like, how can you become the most expensive competitor in the industry and still have people lining up to do business with you versus competing on price? But to say, okay, we're going to go ahead and for these companies, we're going to focus on delivering value. At some point, though, that value has to be quantified and measured. How do you measure that value for an appropriate exit?
So another, again, I do this effectively for a living now. So there, you ask for kind of the secret sauce, if you will, and there are a bunch of very nuanced things that I think are important. For example, one of the things when we think about quantifying value, I always tell entrepreneurs is it never matters what your math is. It's always about the buyer's math. And so what would your company represent to the buyer? Meaning, what if they sold your products and services to 10% of their customers? That might be bigger than the business you've created. Just 10% conversion to their customers because you're giving them a product their customers need and want, or you're giving them a new distribution channel or a new approach, or maybe you're giving them a brand. So a lot of times it's looking at these prospective buyers and saying, what would my company be worth in their hands? And so doing math from their point of view is often the eye opener. The example I sometimes give, this is a true story from about 2 years ago now, a really small software company I was advising that was just coming out of beta. They had about 5,000 customers and they had this little recurring revenue in the sports space. And they came to me and said, what's my company worth? And they had talked to a few bankers that said, well, you're at about $1 million in revenue. You're just getting profitable. It's really small, it's high risk. Maybe it's worth $1 million. Maybe it's worth a few million. And they ultimately were talking to a company that had a very traditional business selling sports, spring and summer sports programs out on the field. And this company had 600,000 customers, but they were really trying to get away from the spikes of spring and fall. They do a ton of revenue in spring and drop in the summer, and a ton of revenue in the fall and drop in the winter. And so I said to this software company, what's the buyer's math? What if they bought your business and maybe 10% of their customers use your products and services? At this point, they were charging, I think, $16 a month for this. I said, well, that's if 10% of their customers use it, it's $12 million. I said, exactly. $12 million in the first year to a buyer if they just got reasonable conversion of your software to their customer base. Doesn't mean someone's going to pay you $12 million, but it means the conversation is very different. You're not talking about a $1 million small software company. You're talking about handing that buyer $12 million in revenue in the first year. So it's really using the buyer's own math as leverage in terms of how value is created.
So there's a few things that you brought up that are actually really good. The acquisition can be a growth strategy. Like, some people are looking to acquire a business because they're like, I want to own this business and I want to build it and I see so much more potential and I want to grow it, make it huge and make a lot more money. And so that, that is some perspective. And then the other perspective is they see acquisition as a growth strategy. To your point, which is fantastic, is somebody might look at it and go, well, our company right now has been predominant, and I'm just making this up, I'm not saying my company, but an investor would look at it and go, our company is based on word of mouth and referrals, and we need to go and expand it. So we're going to buy this other company that has already figured out the marketing channels and how to get clients and so forth at scale. So we're going to buy that. In this way, we have that IP and all the data and whatnot in order to immediately streamline our operations. Or they might have access to shelving space, or they might have partnerships and relationships that these companies are looking for. There's so many different value adds that you mentioned that when people are looking to exit their business, If they're solely looking on, oh, I'm selling the business for somebody that wants to invest money and grow it, make it huge, you're limiting your buyers. Versus if you say, I'm going to create a business that's incredibly valuable to another company as well as to my clients, now you're opening yourself up to two potential buyers. And that can be real big, because I can almost see, to your point, I almost look at it this way. That example that you gave where, that company 10% would represent $12 million. When I reverse engineer it and I go, okay, would it make you nervous if a competitor bought that company? And they're like, yeah, it would scare me.
Yeah.
So it'd be like, that in and of itself presents an enormous opportunity, and people will pay irrational prices for the fear that a competitor actually owns that business.
No, it's exactly right. I mean, one of the things we do in our sort of work, our program, is we talk a lot about, I like to have 3 to 5 different categories of buyers who would value a business, any particular business, someone I'm working with. And what that means is you have to move away from the two logical buyer groups that almost everyone has. One is a traditional financial buyer, which is private equity or whatever. And the other is your own industry, a larger version of yourself. And so if you're a $10 million supplement company, the logical buyer is a 25 or 50 or $100 million supplement brand. But the biggest multiples and the biggest exits almost always happen when someone outside your industry is trying to break in and you have something that allows them to enter the space, or you have a offering that really solves a problem for them. And so it kind of forces you to be more creative and say, okay, who else would value something I've created here? And even in one of my own companies, it was such interesting validation. It was actually frustrating at the time, candidly, but we talked about NBC Sports, or you mentioned in the intro, I sold one of my companies to NBC Sports, and it was a technology company that I would argue to the ends of the earth, for anybody that would listen, that we had the best technology in the industry. And we were really trying to decide, could we compete with these very, very big, well-funded media companies and technology companies, or did we need to sell? And ultimately, we decided, of course, to sell. We sold the company. But what was interesting about it is about 24 hours after the acquisition, they just turned off all our technology. They didn't care at all. That was not why they bought the company. Truthfully, we had a lot of stuff that I think was valuable and interesting, but we had an exclusive distribution deal that allowed us to go out to get youth sports clubs in a very direct, very unique way. And it was exclusive. We were the only company that could do it. And NBC and others identified that as a key distribution strategy. They wanted, instead of cold calling and doing all the things they needed to do sales and marketing wise, they wanted my distribution channel, which honestly was like a sheet of paper. It was a deal I signed with a company. It was almost a single sheet of paper that gave me this exclusive distribution right. It was worth millions and millions of dollars to them to have that distribution partnership. Everything else in the business to them was very secondary. Technology, brand, IP, all the stuff that we were building. Not to say it wasn't valuable, it was just overshadowed by that one strategic thing that they had to have. And the reason I just thought of that is because the other thing that happened is we were in negotiations with another prospective buyer. And ultimately, the conversation I had with both groups was effectively what you said. How would you feel if we sold to the other party? And they were both like, if the other group got a hold of this distribution and that technology, it would be, horrific. Exactly. So who wants to pay us the most? So that's basically your leverage, is letting people know that you solve problems for them. But if you solve it for them, you could also solve it for their competitors and people that might become their competitors. And so that's real leverage in negotiations.
So we have a number of clients that have grown and scaled over time and have taken their business to a healthy 8-figure valuation. And they're not ready to exit, but they are willing to take some money off the table. Mm-hmm. So what advice do you have for those business owners that are like, I want to take some money off the table, but I don't want to exit it completely because I understand that there's so much more upside here? What advice would you give to them?
Yeah, it's a great question. So one of the things that I tell almost every entrepreneur is my core belief is you want the option to sell 100% of your company. And the reason you want the option is if you've designed your business so you could sell 100%, so someone wants to pay you maximum value for it, it's all on your terms, it's your valuation, then every other transaction is a subset of that. So you decide, I don't want to sell 100%. I want to recapitalize, take chips off the table, and double down on growth, get a second bite at the apple. Well, that's a subset of being ready to sell 100% of it. You still have to go through the same process in terms of getting your ducks in a row, creating what I call an irresistible exit story. So someone wants to do that deal. So all of the work is basically the same. But I really love those, we typically call them recapitalizations because it's kind of the best of both worlds for an entrepreneur. You're de-risking, so you're taking chips off the table, hopefully significant money. And that means your risk of something crazy happening in the world is mitigated. Like if there's another global pandemic, if there's a recession, whatever might be a risk to your business, you've taken chips off the table. But you also now have a partner who's invested in your growth, and you typically are rolling equity in beside them to say, all right, I'm going to sell the whole thing in another 5 years. That's the typical model. You take chips off the table now, you double down, you fully exit in maybe 5 years. Sometimes that second exit is much bigger than the first. And so it's really, you get money now and you have an option for a really big exit in the future. So I love that option. I think you still have to prepare and be ready and have your diligence materials ready and have your story ready and be buttoned up, all the things that we recommend, because the process is exactly the same, whether you're selling 1% or 100%. They're going to do diligence. They're going to have to get comfortable. They're going to, kind of take you through this whole process. It's just the structure of the deal is a minority versus a majority exit.
Now, when people are going to sell part of their company, I think the traditional route is let's go knock on the doors of as many PE firms and whatnot to try to see if they're interested. But that actually is, I would argue, possibly it's a good option, but maybe not the best option for those who want to take some chips off the table. So let's say you're talking to somebody that said, okay, I want to take chips off the table, but I want to find a buyer. How do they go about finding a buyer?
You're exactly right. I mean, private equity, kind of traditional private equity, is absolutely one of the categories that's on the list. And so I would always have them there. It may or may not be the best option depending on, people's goals. I can sometimes come across as being negative about private equity, but the reality is there are situations where it's the perfect partner, it's the perfect buyer. It really depends on your goals. So I always like that as an option. There are, depending on the size of the company, low to mid 8-figure businesses, sometimes family offices, or even ultra high net worth individuals can be perfect partners because they want to grow a business. They have the capital. They value your role as an entrepreneur and they want you to continue forward with them. So sometimes they're a little non-traditional, but can be great partners. And then there's the whole category of strategics, which are in your industry, outside your industry, that really want to grow something together with you. So that's kind of the art and science a lot of times of what we end up doing with people is let's think very creatively about who would value this, who might like to be a partner, who might like to invest, who would allow me to take chips off the table. But the key is to have 3, 4, 5 different ideas before you even start. Private equity can be one. Your own industry can be one, but you still need 2 or 3 completely different creative ideas of who would like to partner with us, who has the capital to do it. And that allows you to go to the market with lots of flexibility and really find the perfect partner.
The other thing for our listeners to consider is that you're really only limited to your imagination when it comes to an offer. I want to sell my business for X amount of dollars, and that's what it is. So there's a lot of creative ways. You used an example earlier about, a company saying it was about $1 million or thereabouts. These investment bankers were giving it about $1 million, but a partner could potentially, it's worth over 12 million to this partner.
Exactly.
It doesn't mean that the partner might not be willing to spend 12 million on day one, but there is a possibility of getting 12 million down the road. So Give us an example of a creatively structured deal that would allow a company that may be an IB $1 million, but then they could actually get a $12 million exit with the right advisory. And
yeah, no, your point is spot on, which is, it really is only limited by your creativity and your view of risk. In a lot of cases, the traditional kind of upside scenario is some sort of performance or earnout. So, you say, hey, I'm going to sell you part of my company today and I want $1 million in cash, but I think there's $12 million worth of value that you're going to get from being an owner of my business. And I'm willing to take $1 million now, and every bit of the upside from that $1 million is going to be in a rev share. I get 50% of the revenue or 50% of the profits, and you get 50% of the profits up until $12 million, which I think you're going to get in the first year. And then in year 2, we're going to split it 70-30. And then in year 3, we're going to split it, 80-20. And so my ownership my percentage is going down. You're benefiting more and more and more. But I'm just building a way that I'm going to keep making millions of dollars without them taking much risk. And I have zero risk. The biggest risk in that scenario, I say zero risk, the biggest risk is they don't perform. Earnouts and performance deals for an entrepreneur, your biggest challenge is if they don't do the work, if they don't structure the deal, if something falls apart, you might not get your full potential. But I always advise my clients, people I'm working with, I say, cash at close and guaranteed cash is the number. So you have to be contractually guaranteed to get whatever you think your minimum is. Then we can get incredibly creative to create upsides and formulas and participation that you hope is going to be very meaningful. But worst case, you got the cash deal. And so I think that's sort of the trick, is finding the right balance of guaranteed cash. It doesn't have to be at close. It can be paid out over time. I'm still getting paid out over a company I sold 5 years ago. I agreed to take payments monthly for years and years and years. No problem for me, right? It's contractually guaranteed. Made it easier for the buyer, made it good for me. So I'm a big proponent of, let's get your deal nailed down and guaranteed cash, but convince the buyer ultimately that that's the minimum. What you're really excited about is the future, all these great opportunities. And that's where we can get creative. And so that can be really fun and lead to great upside.
There's a couple other points that I want to ask you, and I'm loving this conversation. We could literally talk for hours, and I wouldn't do that to you, but we could. Let's talk about the impact on the CEO. Sometimes what I find is there's this dream, this excitement of taking some chips off the table, and they just assume that, okay, I'm going to cash out. I'm going to put all this extra money in my pocket. I still have to run the business because I'm still going to own X% of the business. I'll make it happen. And I'm going to continue to live with the same amount of freedom and continue with the same level of just visionary discretion. And life for me as a CEO will be better because I'll just have more money, but everything will just be roses and sunshine. But I've seen enough of my clients go through this to realize that in most cases, not many, but in most cases, it's actually a rude awakening when they realize that they have to answer to somebody else now. Could you talk to us a little bit about the impact, and then what are some of the ways that they can mitigate that impact in a deal?
Yeah, really, really key point. And I think, over the years, I've determined there are several different types of entrepreneurs and certainly executives. In a lot of cases, you find an entrepreneur who is the founder of a company, a leader in the company, maybe holds the CEO title. So they're wearing all those hats and have all those roles. My particular style of entrepreneur, for good or bad, I loved every company I started. I pursued it because I was passionate about it, but I also was very happy to sell it. It was not my baby. It was a business, and I was always excited about the next one and the other thing. And so for me, it was very easy to sort of bifurcate and say, I'm selling this business, and my role with the buyer, because there's almost always a obligation or a commitment to do something for the buyer. Employment agreement, consulting agreement, a year long, 2 year long, some time period where they want you to be a part of the business, primarily to mitigate their risk. They don't want the deal to close and then clients leave and employees leave and things fall apart. So they view the transition of a CEO and a founder, a key stakeholder, as mitigating their risk. So I tell you all that to say, in my case, my style of entrepreneur, if you will, it was very easy to look at it and say, I am skeptical that I'm going to enjoy working for the buyer, but I'm going to sign an employment agreement because it's required to get the deal done. And if I am happily surprised because they're going to pay me well, I'm going to get benefits and there's going to be some good things, maybe, just maybe, I'll enjoy it. Chances are I won't. In my case, 99% of the time, I didn't enjoy it. I did my minimum requirements under the contractual agreement. Meanwhile, I was working on my next business, thinking about what I was going to do next, trying to enjoy life during a transition period. I think 4 times I resigned on day 366, one day after my employment agreement ended, just because that was, my minimum. I say all that very long sort of backstory just to say, when I'm advising people now, I often say, go into the employment agreement or the consulting agreement with low expectations, negotiate what's fair for you, get equity, get a salary, all those things that are, typically it's separate from the agreement to buy your company, because now they're having to legally agree with you to do something different in the future. So you have this new contract, it's a new opportunity to lay it all out. But don't go in it with the expectation that it's going to be rainbows and sunshine, because they're going to have different goals, different expectations. There are bosses that are probably something you're not used to. And in most states in the US, in most places in the world, if you're not happy, you can leave. Even if you've signed an employment agreement, they're not enforceable, especially these days. And there's been new legislation. So I like for people to go in with, maybe it's going to work out, maybe it's going to be fun, maybe it's going to be great. But chances are, if you're a true entrepreneur, it's going to be hard to work for someone else.
I have a client that he said, every quarter I have to spend the last 3 weeks preparing for a board presentation, and it's nonstop and it's exhausting and it's a waste of my time, but they're making me do it. And other things that I've heard would be, they're pushing their vendors and their partners that they work with to work with us, but we don't want to work with them. We don't think that, but we have to do it because, they're pushing these people. There's this feeling of, I used to be able to take Fridays off and it was great. I had my Fridays off and the whole deal, but now they're breathing down my neck and I feel like I'm a high paid employee as opposed to, so they're very seldom have I met somebody that said, oh, this is the best thing in the world. It's easy. They let me run completely autonomously and whatnot. And I think to some extent, it all depends on how well the business is set up and if they are prepared to sell. And from my experience, and you may tell me completely differently, Mac, my experience is most companies, when they make the decision that they want to take chips off the table, they're not ready to sell.
100%.
And so when we say a company is not ready to sell, if you were to envision sort of like this checkbox, like, do you have this? Do you have this? Do you have this? What are some of the requirements that you look for our listeners that are saying, is my business ready to sell right now?
Almost every successful business, especially if it's a high growth, 7-8 figure business, for example, they are run by people who are incredibly talented at something, engineering, design, sales, whatever their unique abilities and skills are. It's very rare that same person happens to also be an exit expert. It's really rare. And so the whole process is new to them. They have no idea what to expect. They're going to learn the hard way. And that often means leaving life-changing money on the table if they do sell, because they really weren't ready. So if you rewind and say, okay, well, how do you become ready? One is, it takes time. It's like, Einstein called compounding interest the 8th wonder of the world in the stock market. Same thing is true with exit preparation. I love when people start working with me 2 years before they want to exit, because all the little things that we talk about have time to compound into value. If you decide to get ready to sell and you want to sell by the end of this year, maybe you can start the process. There's no way you're going to have done enough to really be ready. That tends to exist across the big buckets, right? Financial. Are all of your financials up to date? Are they documented? Are your chart of accounts very consistent in the industry? Because when people start looking at your financials, if you've changed names to be creative because your business is different and your industry is different, every one of those things is yellow flags and red flags to a buyer. What does this mean? Why is it coded this way? So you really have to think about looking at your business through the lens of a prospective buyer. And certainly financially, most people aren't ready. When you start due diligence, you're going to get a list that typically is a 3-page long, single-spaced due diligence request list for every document, financial, employment agreement, contract, everything that is a deep dive into your company. And what I always tell our members is that for most people is weeks of, oh my gosh, where are those? I've got some digital and some paper. Some are in a file cabinet. That one got lost. That is a scramble. For us, we create a deal room that my goal is for people to be able to say, as soon as you get a due diligence request list, you right click and share. It's already organized in the same format as the standard due diligence request list. So that's operationally prepared. Do you have systems and processes that will convince a buyer that the business can run without you? Again, if you're a key stakeholder, you're the founder, you're the CEO, they need to be confident that it runs without you. Because even if they want you to continue for a year, nobody wants to buy a business that the founder's involved in everything, in the middle of the process, in the middle of the sales, if you're in the middle of all that stuff, it's not sellable, or it's never going to be sellable for the value it should be. So you have to start to extract yourself and replace yourself with other people, other processes. Those processes have to be documented. So those are the kind of things that we say, if you're doing that work a year or two in advance, it's like 30 minutes on a Sunday, every Sunday doing a little bit, and then you're ready. If you have to get ready in 2 or 3 months, it is a scramble and probably one of the biggest of your life.
What we find is that most companies that built their business to about 1 to 3 million on the backs of word of mouth and referrals, hard work, word of mouth and referrals. And if your business is built on the back of hard work, word of mouth and referrals, it's not even time to think about an exit. You have to get beyond that to create scalable marketing and sales systems and other things so that it reduces the dependency on your network, on your relationships, on your hard work, and then, adds to that scale. On the diligence side of things, one of the things that I've seen over and over and over again, especially in the PE crowd, there's like these dirty tricks that are so predictable every single time. It's like, as soon as it's PE, I'll warn my client. And I don't do the same thing that you do. They just, they're coaching with me and whatnot. I would recommend, if you're going to an exit, talk to somebody like Mac, because Mac has the expert and position you for an expert. But, I work with these clients coaching on the marketing and the sales and, team dynamics and all that other fun stuff, right? So inevitably, every single time they go to sell to PE, I said, here's what's going to happen. They are going to get you so excited about the money so that you're sitting there and you're imagining the car that you're going to buy once the money hits the account, the new house, the private jet, all this other stuff. Like, they want you to get so excited about this stuff that you're just frothing at the mouth. And then what's going to happen is right before the close, they're going to reach out to you and they're going to be like, we found something and we can't move forward unless you're willing to discount it to X.
Oh, yeah.
Every time. I haven't seen an exception yet. How common is that type of those games played?
I would say it is 100% of the time. And to be generous, or I was going to say fair, but I'm going to say generous because it's probably generous, not fair. Sometimes there are legitimate, they dive in, they start digging in. And of course, every business has problems. Every business has issues. Every business has a customer that's probably going to leave and an employee that's unhappy, right? That's the real world. And of course, that thing that you might even know about in advance is suddenly going to become the most important thing in the world. Well, we were going to pay you 10 million, but now that this customer is going to leave, like, we couldn't do it for anything more than 7. But like, they're not a $3 million customer. Yeah, but it's a signal, like customers are leaving, so it's almost like a magnet. They hone in on the thing. And so you're exactly right. I always tell people the letter of intent which is non-binding. And that's going to give you the deal, the range, kind of the sense of what they're going to pay you. And you're right, as an entrepreneur, as humans, we go, okay, I'm about to get $10 million. I should go pick out my Ferrari. The deal only gets worse from there. It never gets better. Now, there are little tactics and things that I know can help people in negotiations, but the reality is diligence is going to identify things that are going to shift or fundamentally retrade the deal. Sometimes it goes from, they don't say we're not going to pay you 10 million, but we're only going to pay you 6 guaranteed. The rest of it, you're going to have to prove now. It's going to be in an earn-out. It's going to be in a multi-year, long-term, relationship. But that is almost always the reality of what happens. And again, it's not always disingenuous. They're trying to screw you. Sometimes they are, sometimes they're games, but a lot of times it's just the more they dig in, they find things that they have to mitigate or going to use as a way to structure the deal differently to mitigate risk.
Gotcha. Makes sense. Now, I know we're pushing up against a clock. What would you say would be your biggest, best tip for our listeners that want to take their business beyond 7 figures?
For me, I would say businesses that scale are always built on the back of 2 things in my experience. One is great people and systems at scale. And I think you said it earlier. I used to jokingly say I don't have enough friends for my business to be the friends of Mac. If that's my customers, I'm not that popular, right? So I have to find great people. Every one of my companies, all 6 businesses, as much as I'd like to hold up my hand and say I did smart things, I can absolutely tell you it's because of the people I surrounded myself with. Employees, co-founders, advisors, mentors. That's why we built big and successful companies. And the other is when I figured out to get out of my own way, and it needs to be a system, not something in my head. Those are the things that, to me, take a business from 7 to 8 figures.
I love it. And tell me a little bit more, tell our listeners a little bit more about what you do and where to find you and so forth.
Yeah, thank you. So at this point, I have kind of shifted my energy into mentoring, advising entrepreneurs. Is something I'm passionate about. It's kind of the second half of my life I wanted to, help. So I have a program called Exit DNA, which you can find on, exitdna.com or on social media at Mac Lackey. And it's really just working with entrepreneurs to create the option to exit. It's a lot of what we talked about today. I don't care if people decide to sell their business or not. I know from a lot of experience, good and bad, if you design your business so that people want to buy it and you know who should buy it and you know what it's worth, then every other option is available to you. Raise money, raise growth equity, take chips off the table, or decide to keep a better business for yourself. All of those are enhanced by looking at your business through the lens of optimizing for exit.
I love it. So, ladies and gentlemen, when you think about today's episode, we started off by talking with Mac about this idea that, look, it's one thing to have one exit, then it's something else to have a second. When you have 6 exits that are 7, 8-figure exits, like you're onto something. So Mac sort of dived in on his principles, and one of the core components of that was build your business based on the value that you're able to provide others. When we started talking about the sale of the company, or, as another company would be acquiring them, both as a growth strategy, but it's also as well as, so there's one as a growth strategy. There's another opportunity where somebody just wants to buy the company outright and then grow it on their own. But there are a lot of ways to ensure that you can get maximum valuation. Look, even if you're sitting here right now and you're saying, I don't think that I'm ready to sell my company, or I love what I'm doing, I have no interest in selling it right now. Here's the thing. If you are a CEO and entrepreneur and you want freedom, freedom comes with options. And you just need to have the option. So you might not be willing to or interested in selling today. God forbid something maybe happens tomorrow and now you got to focus your attention elsewhere. Having that option to be able to sell would be great. Or maybe you just all of a sudden decide 6 months from now, you know what? I want to spend more time with the kids, travel the world, and so forth. I'm looking for an exit, having that option to do so. When you build your business so that it is saleable, and you build it with that intention on day one, it gives you that option, it gives you that freedom. You're increasing the value of your business in and of itself, and you'll be off to the races. The worst thing is that you don't build your business to sell. you turn around and you go, you know what? It's time for me to get out. And then you talk to somebody like Mac. Mac goes, it's going to take about 2 years at least to get you going. So you want to make sure you build your business so that it's saleable. That's a really important thing. So I hope you enjoyed today's episode. This was easily one of my favorites. I've really enjoyed it. Mac Lackey, he's over at Exit DNA. Check him out and connect with him on LinkedIn. Look for him, all that other fun stuff there. I think you'll find it worthwhile for you to learn more from Mac. For more people who are looking for additional tips, strategies, and information to take your business over to that next level, check us out at predictableprofits.com. Again, that's predictableprofits.com. This is Charles Got Out with my friend Mac Lackey, and I will see you in another episode.